It's Friday, April 4th, and we're talking about the industry powering the digital revolution. I'm your host, Dylan Lewis, and you're actually not going to be hearing much from me today. We put out a lot of content here at The Fool, and every now and then I'll hear a conversation and think, this is darn good. We've got to get this in front of as many people as possible. On today's show, we're going to be airing a conversation between analysts John Rotonti and Jason Hall, breaking down the semiconductor industry. It originated in our Discovery Now premium live stream and then later made its way into Motley Fool Live, our US member live stream. It's a fantastic overview of the industry, the shortage that's been collecting headlines, and why this space is full of so many stellar businesses. Think of it as a little sneak peek for non-members and a reminder for all of our members that there are some awesome conversations happening over at live.fool.com. Without any further ado, enjoy.
So before we talk about our show today, which is going to be focused on the semiconductor industry and what's going on there, I think it'd be great if you could just spend a couple minutes talking about what you do for The Fool and what you enjoy the most about the things that you do.
Thank you, Jason. Yes, so I'm a senior analyst. I've been at The Fool for 7 years now, and I'm the head of investor training and development. In that role, I teach a lot of classes to our new analysts. That's one thing I do. In that role, I also serve as a resource across our investing team. So if any member of our investing team is looking for an article or even maybe some Wall Street research on a particular company or a model on a company, I may be able to help them with that. Third thing I do is I bring in outside guest speakers, practitioners, academics, but all superstars in their fields, in their area of expertise, to come speak to our team internally, teach us classes, lead discussions. Sometimes I bring in a group of outside speakers and we host roundtable panels. And we just get to watch these 3 or 4 amazing professional money managers have a discussion with each other for an hour and a half. And so that's how I spend my time as a coach. And then I'm the co-host of the morning show on Motley Fool Live and the host of My Investing Life on Motley Fool Live. And then I'm experimenting with another show called Tech 30, where I bring in some guests and interview them for 30 minutes and talk about tech and innovation.
Awesome. Well, there's no doubt that tech and innovation, it's the old software is eating the world. And the bottom line is that every company that's not using technology in their business is going to lose to their biggest competitor, who is.
Exactly.
So that's awesome. Well, John, again, thank you so much for coming on. And I can tell you that every member, whether they have listened to you talk about companies that you follow, or back when you were working on some of the premium services and providing the analysis that led to recommendations, every single member has benefited from you because of your influence on so many of the other analysts and helping out with coaching and training. So I just want to, for every single member, I want to extend a thank you to you for that.
Thank you, Jason. Thank you.
All right, on to today's show. We have a fun topic lined up. One of the law of unintended consequences that's happened recently, that's had all kinds of far-reaching implications across all kinds of industries, is the semiconductor shortage, right? So whether it was coming out of COVID and the impact on global supply chain, natural disasters, fires, booming economy, surging demand, the proliferation of semiconductors across so many more different types of products than ever. It's an amazing, interesting industry that's kind of in a bit of a disarray in terms of meeting supply, but has so many implications that investors need to understand. John, tell us what we need to know.
Yeah, Jason, regarding the shortage, you hit on most of the big ones. I think the biggest reason there's a semiconductor shortage right now, I think, is because of the digital acceleration that was brought on by COVID and the subsequent economic lockdown. So digital everything and the cloud was growing really fast before the pandemic, but the pandemic accelerated that growth. And those industries, whether it's software, whether it's hardware, whatever it is in the digital space, relies on semiconductors. And so when the digital transformation got accelerated literally by years, down into months, the semiconductor manufacturers were already operating at full capacity or near full capacity. And so it takes time to ramp up semiconductor manufacturing. So that's a big thing. The industry was not ready for this accelerated digital transformation. You mentioned natural disasters. One major semiconductor fabrication facility was shut down by a fire, another by the deep freeze in Texas. And then a third thing I'll say is coming out of recessions or these sort of economic shocks, it's not uncommon to have supply constraints. It
Right.
just so happens this time the supply constraint is showing up in semiconductors because of the digital acceleration we talked about and how important semiconductors are to everything digital.
Yeah, it's a confluence of events, right? There's so many things that have occurred all at the same time that have made what was going to be a tight supply situation even worse. And you hit on something I think is really important to understand. And talking about bringing these facilities up to scale and adding more capacity, I think we've all gotten spoiled when we see CrowdStrike report earnings or Zoom report earnings or Shopify, where their revenues are up 50% or 100% from period to period. And when you're dealing with software or software as a services or something on the cloud, you can scale up very, very, very quickly. But when you think about building a foundry for semiconductors, and a lot of times they're very specialized, right? Making sure that you're building out the right capacity for the right need can be really, really critical. And it does take time. It's very time intensive, very labor intensive, very energy intensive. And then there's all the logistics of the, oh yeah, it's very power intensive. But then you have the logistics too of the inputs, your feedstocks that you need, and then getting the product out and then getting it distributed to where it needs to go. It's about as old school as it gets.
It takes years to build and $10 billion, $10 to $20 billion to build one modern day advanced node semiconductor manufacturing foundry.
So the one that comes to mind most immediately on that regard is actually a company that we're not really going to talk much about, but that's Intel, right? This is why the company has earmarked, these massive, $30 billion or so to add capacity in the, maybe it's more than that, but to build out more capacity in North America.
Yeah, so if you look at the three largest semiconductor manufacturing companies, Taiwan Semi, I guess we should call them they're more accurately called foundries or fabrication facilities. But Taiwan Semi has announced they're going to spend $100 billion in CapEx over the next 3 years, 100 billion. Samsung, that it's going to spend over 100 billion over the next several years without specifying what several years means. And then you just said Intel. I thought it was 20 billion to build 2 fabs in Arizona, but maybe the number has gone up to 30.
Yeah, I think that sounds right.
But it's a lot. I mean,
it's a lot.
It's a lot. And so just 3 companies right there, you're looking at well over $200 billion of industry CapEx in the next few years. That's a lot.
It is. And then they're going to have to be regularly spending additional capital costs to modernize, to update, just to continue to meet the design expectations.
Yep. Taiwan Semi is the leader in this. They're currently the only company globally at scale putting out 5 nanometer chips, which is leading edge chip right now. They're gonna open their first 3 nanometer chip sometime in 2022. That's the timeline they've announced so far. So yeah, they're continuing to move, continuing to progress and innovate to more advanced chips.
So before we get into the specific companies, it might be helpful to talk about, as you think about the industry, and as you think about how it's the buckets that the industry is kind of within and the companies that participate and what they do. Can you kind of break that down for our viewers?
I can, for sure. So what's remarkable is that at every stage of the semiconductor manufacturing value chain, there's like 2 or 3, and in some cases 1 global leader. So we're really talking about earned oligopolies, earned duopolies, earned monopolies in some cases, because it, as you said, it's just so capital and knowledge intensive that the barriers to entry are just so high. And so really, if you look at how to make a leading edge 5 nanometer chip, for example, the first step is, because these leading edge chips, they have billions of transistors on them, and the chips are about the size of a stamp or a thumbnail. And so you can't just, and when I say billions, I mean billions. The Apple M1 chip has 16 billion transistors. The Amazon Graviton chip has close to 30 billion transistors. So tens of billions of transistors. You can't just put that together by hand.
Right.
You need software. So the first step is to design the blueprint for that tiny chip and how you're going to fit 20 or 30 billion transistors on it. And there's 2 global leaders in software that do this design. It's called EDA software, electronic design automation software. It's also sometimes referred to as computational design software. 2 global market share leaders, Cadence Design Systems and Synopsys. This computational design software, it's highly complicated. It's a mix of matrix algebra, artificial intelligence, advanced geometry, and other fields of math that I can't even pronounce or understand. It's really that complicated. To work as a software engineer at one of these companies, you have to have a master's or a PhD. It's not just you take a class in Python or something like that. It's super advanced. So that's the first step, is you design the blueprint of what the chip is going to look like on this software. There's to global duopoly. The next step is basically chip making has 1,000 steps basically, but you can basically break it down into, you deposit film onto the silicon, onto the wafer, and this film is different chemicals, and then you etch away or cut away at that film, and then you wash with water, and you repeat that tons of times. It's more complicated than that, but you repeat it tons of times. So the next step after you make this blueprint with the software is you do the deposition. You deposit these layers of chemical onto the wafer, and there's 3 companies that make these deposition machines: Applied Materials, Lam Research, and Tokyo Electron. But in deposition, Applied Materials is the industry leader. Once again, an oligopoly. After you have done the deposition, then you take the blueprint that was created with the software, and it is shined. You use a light source, and you project that blueprint through a mask and through a series of mirrors onto the chip. And this mask and these series of mirrors shrink down that blueprint to the size of a chip. And how it's done is really magical. There's only one company that provides the light source that is shined through this mask and through these mirrors to shrink the blueprint down onto the chip, and that's ASML. It's the only company on Earth that has this extreme ultraviolet or EUV lithography. And basically, it's a tiny wavelength of light that is shined through this mask and these mirrors to trace or stencil the pattern onto the silicon wafer. And the way it works is people thought it was impossible. Industry experts thought it was impossible, but ASML figured it out. And a tiny drop of molten tin is hit by carbon dioxide lasers, CO2 lasers, and the lasers vaporize the molten tin. That tin turns into a ball of plasma, shining so bright that it creates this EUV, this extreme ultraviolet light source. The science is so complicated, no other company has been able to figure it out. This process of shining these lasers onto the tin, creating this plasma ball of light, happens 50,000 times a second. And so the reason EUV, extreme ultraviolet light, is so important is because extreme ultraviolet light has a tiny wavelength of light.
The wavelength. That's how you get smaller and smaller and smaller.
And if you're putting 20 billion transistors onto a chip, exactly right, those transistors have to be packed really close together. And so the tracing, the stenciling, has to be used with a really small wavelength of light. So we've deposited material. There's an oligopoly of companies that make those machines. We've done the lithography, the EUV lithography. There's only one company that makes those machines. They cost about $200 million. And then we have to etch away or carve away at the deposition. to lay down the transistors and then to connect those transistors. There's 3 companies that make those machines. They're called etching machines. Same 3: Lam Research, Applied Material, and Tokyo Electron. But in etch, Lam Research is the leader. And so at each stage of this value chain, you have like monopolies, duopolies, or oligopolies, because these companies are so unique and so important, and what they're doing is really bending the laws of physics. It's almost impossible to replicate.
Well, I think I don't know if you're familiar with Arthur C. Clarke, the science fiction writer,
Sure.
known for his Clarke's 3 laws, and I think this is perfectly the perfect application of his 3rd law, that any technology that is sufficiently advanced is indistinguishable from magic. So,
so industry, you're exactly right. Industry insiders call this process of making a chip, they call it black magic. Yeah. It's really, really complicated. And all of this happens, by the way, at one other company operating a global oligopoly. All of this takes place at a foundry, at a contract manufacturing facility. And the leader there is Taiwan Semiconductor. And so the deposition machines, Taiwan Semi buys them. The etch machines, Taiwan Semi buys them. The extreme ultraviolet lithography machines from ASML, Taiwan Semi buys them. They spend the capex, they buy them, they put them in these massive facilities, much bigger than a football field. And they go through these thousands of steps. It's called a recipe, and they make these advanced chips, and the process is like magic.
And the business model works because if you're Apple or you're Microsoft or you're any one of these companies you're Ford, right? Any one of these companies that's utilizing semiconductors, even if you're designing them yourself, spending the money just to build out spending the capital to build out a facility to manufacture it yourself is almost nuts, right?
So these companies, they're called fabless because they don't have fabs for fabrication facilities. That's exactly right. They put the capex burden onto Taiwan Semi.
Right.
It's a mutually exclusive relationship, though. Taiwan Semi is getting good economics from this as well.
That's the key. It can be cheaper unless you can produce massive volume for your own consumption. It can be cheaper to be fabless, to use somebody else to manufacture it, because when they operate at scale, the volumes they can produce, right, drives down the per unit cost, and they can be profitable producing it for cheaper than you could do it if you did it in-house.
That's exactly right. And then, of course, the advantage to Taiwan Semi is, so the way that these chips are made, when you go from one generation of chip to the next, you start with the recipe. You start with the process knowledge from the prior generation. So to go from 7 nanometer to 5 nanometer, you start with 7 nanometer, and then you tweak it from there. Right. And so Taiwan Semi has done more of these advanced chips than anybody else. So they have more process knowledge than anybody else.
Which is a major competitive advantage.
It's a major competitive advantage, Jason, and it's really hard for others to catch up because you can't skip steps. So Intel is behind now. They have to do 7 nanometer. They can't just, because they can't figure out how to do 5 or 3 without going through that process knowledge and learning those steps as they go. So that process knowledge, that IP, the library of recipes that Taiwan Semi and Samsung has built up, and Intel to an extent, that it's an amazing competitive advantage.
So now that we've got kind of a baseline of knowledge about the different parts of the industry and the levers that are tied to it, let's spend a few minutes. We've already been doing this for about 19 minutes, John. That's amazing. It feels like it's been 19 seconds. This is incredible. If we can spend maybe 10 minutes or so talking about some of the top companies here that you've identified that you like.
2 of them or 3 of them I've discussed already. So we'll be able to be efficient with the 10 minutes we have. ASML is the only company on earth that has figured out extreme ultraviolet lithography.
Right. And
so Moore's law says that every 2 years or so, the number of transistors doubles. The only way to double the number of transistors on a chip, if the chip size doesn't change, is to shrink the transistors and push them closer and closer together, and then to build these 3D chips and to put them on top of each other. But the only way to do this shrinking is with this really ultraviolet wavelength of light. And so ASML is really the company that has allowed Moore's law to continue to progress for so long. So ASML has an earned monopoly. It is truly a magical company. They are bending the laws of physics. To catch up with them is going to be really, really, really hard. Lam Research, I mentioned, and then Taiwan Semi, I mentioned. All unique businesses, as, in my opinion, as difficult to replicate as any businesses on Earth. I'm not going to say as impossible, but as difficult to replicate as any business on Earth. One we haven't discussed yet is Texas Instruments. So the ticker there is TXN, and it, once again, back to this theme, it operates in a global oligopoly or duopoly. So Texas Instruments is the largest, analog semiconductor company in the world. And Texas Instruments and the number 2 runner-up player, Analog Devices, they control about 50% of the global market share for analog chips. Texas Instruments has an extremely diverse revenue base because they sell 100,000 different products to 100,000 different customers. They sell more products. Their product portfolio, their menu of products, is larger than any other semiconductor company on Earth. And they sell to more customers than any other company on Earth. 100,000 products, 100,000 customers, so really diverse revenue. The question I get most often with Texas Instruments is, why are they selling these analog chips when everything is going digital and digital is exciting and it's fun? And the reason is because TI is an amazing business. It's run by amazing leadership, and they realize that there's this analog paradox at work. And you probably never heard that phrasing before. I don't think you'll read it in Wall Street Research, but there's this analog paradox at work, meaning that as the world shifts to digital, the demand for analog grows in tandem.
Yeah,
it grows with it, because analog chips, they do things like manage the power in your cell phone.
Right.
So your cell phone is a digital device, but you need analog along with it. And so there's only a few companies really doing this at scale. And then the other great thing about analog chips, as the rest of the world is tripping over themselves getting into the digital space, analog chips have long life cycles. The average, so Texas Instruments is mainly selling chips they're mainly focusing on autos and industrials. Mm-hmm. The average life cycle for one of their auto chips is 7 years. The average life cycle for one of their industrial chips is 10 years. So these chips don't face the risk of technological obsolescence.
And when you say life cycle, you mean the period of time from when they manufacture the first one to when they manufacture the last one?
Yeah, the period of time that's right, or the period of time before that chip sort of goes out of style and it needs to be updated.
Right.
My point is,
as compared to the chips that Apple designs and uses, every new iteration of their iPhone has a new processor.
They're already coming out with the M2.
Right.
They're already coming out with the M2. So they came out with the M1 a year ago.
Right.
It's exactly right. And so there's no risk to Moore's law with Texas Instruments. If they don't sell a chip this quarter, it's got a 10-year life. They'll sell it next quarter or next year at a high margin. Mm-hmm. In fact, Texas Instruments is selling chips that were released 30 years ago. So on average, auto chips have about a 7-year life cycle. Industrials about a 10. They're still selling some chips they designed and manufactured 30 years ago. Keyword manufactured. They're vertically integrated. They do their manufacturing in-house, unlike digital chip companies for the most part, and unlike their competitors. So they are the only analog chip company, once again, a monopoly when it comes to this, manufacturing chips using 300 millimeter fabrication, which reduces the cost to manufacture these analog chips by 40%. So they have ultra low cost manufacturing because they do it in-house. Manufacturing through their in-house manufacturing facilities carries incremental gross margins of 70 to 75%. So you see incredible margins, incredible returns on capital from a company like this. And they're the only company manufacturing in-house in their space.
It's kind of good to be the king, right? I think that's the that's the situation with Texas Instruments.
It's exactly right. And because they control their supply chain more than their competitors, given the backdrop we're in right now with the shortage in semiconductors, their customers aren't experiencing as much of a shortage because they control that supply chain. They're vertically integrated. There's some shortage, there's some hotspots, they call them, but for the most part, their customers are getting the chips they need.
So
It's
here's
a
an interesting
fantastic
thing.
business.
Here's an interesting thing. So every single one of these companies has outperformed the S&P 500 over that period. You know, that certainly supports two things. Number one, the trend, the growth, the tailwind for semiconductors. And it does tend to indicate that the market supports you, John, as saying that these are the leaders in this space.
So that would hold if you look at the Philadelphia Semiconductor Manufacturing Index, and you go back 10 years. Okay, it beats the market 10 years. It beats the S&P. So my point is, it holds going back further. But just looking at the companies that you mentioned today, one of the reasons they beat the index, Jason, is because they weren't trading at these valuations that some amazing software companies, and I love them. But these semiconductor companies weren't trading at the valuations some of these software companies were. So they haven't fallen as much, right? And so like if you look at Texas Instruments, Jason, it's down 10% from its 52-week high. Fastly's down 65%. And so if things aren't falling as much, it helps when it comes to outperformance.
It does. It does. It's also a reminder that to a lesser extent, this asset rotation sell-off that we've seen from some of our more interesting names has still impacted this industry, even though we know that there's strong demand, but it's opportunity. I think that's the key, right?
Oh, it's opportunity. It's
there's
long-term
predictability and opportunity.
The other reason they're outperforming, this is Lam Research. This is from New Constructs. They put out really rigorous calculations of free cash flow and returns on invested capital. Look at Lam Research's returns on invested capital. Gone from 2016 of 21%, trailing 12-month 54%. The average return on invested capital, which is a measure of profitability and efficiency for the market, is about 12%. So
right.
This is a company that's generating returns on invested capital of 54%.
So that screams demand, that screams competitive advantage, and that screams amazing economics.
Yeah.
And oh, by the way, we're really good at capital allocation.
Exactly. You look at free cash flow margins, free cash flows over sales, 17%, 22%, 20%, 26%. I mean, turning 20 cents of every dollar into free cash flow, pretty impressive.
Yeah, that's incredible.
So
that's incredible. Those are numbers to get excited about.
You mentioned the demand. Maybe one thing to talk about from a high level, another reason these stocks and the industry, the Philadelphia Semiconductor Index, is outperforming so well, is a thesis for the industry. So they're a critical infrastructure component to the digital revolution, and everything digital is a large and growing market. And so you've got this long-term tailwind. There's no aspect of the modern digital economy that can function without semiconductors, zero. So cloud, artificial intelligence, machine learning, 5G, video games, electric vehicles, autonomous vehicles, wearables, sensors and wearables, the Internet of Things, automation, robotics, crypto, mining, space travel. There is no aspect of the digital revolution that can exist without semiconductors. And I hear a lot of investors say that it's cloud computing that is powering the digital revolution.
Well, and I would what's powering cloud computing?
Exactly, Jason. And I would agree with that. The cloud is a game changer, but it's a slight oversimplification because without semis, there is no cloud. And then you mentioned cyclicality really early. I just want to hit on that really quickly. The industry is cyclical. There's no doubt about it, but much less cyclical in the past than in the past. 3 reasons for that. One, now they're going into everything. The cycles used to be driven by the PC cycle and the smartphone cycle. Right. Now they're in everything, including cloud, data centers and servers and everything. So now they're in everything. That's number one. Number two, there's been several waves of massive consolidation in the industry, and we're in one of those waves right now. And when an industry consolidates, the remaining players become more rational. And then the third reason you mentioned earlier, now the OEMs themselves, the largest, most profitable, biggest companies in the world, are designing their own semiconductors. It's a whole new customer base. Apple, Amazon, Tesla, Google, Microsoft's talking about this. They're all designing their own semiconductors now. So now that market opportunity is so much bigger.
Yeah, and I think that also changes the capital allocation model, right? Because if you're no longer designing and building it, you're not really thinking about the capital investment you'll have to make to build that new design. It just completely changes the economics.
Totally. And then the final thing we sort of touched on when I shared my screen, the fundamentals for semis have been misunderstood for a while. They're being better understood, but I still think they're underappreciated. If you look at a list of the best semiconductor companies and put it up against a list of the best software companies, the corporate fundamentals are every bit as good for the best semiconductor companies as they are for the best software companies. Their profitability and their returns on capital are exceptional. Their growth is not as good as software, but they are definitely growing far above GDP. And if you look at the most recent downturn in the cycle was 2018 or 2019, the trough margins, so the worse the margins got in the most recent down cycle, were better than the prior peak margins.
That says a tremendous amount.
It's a different industry.
Well, and I think another thing that's worth mentioning too is the way that the industry has changed seems like it supports more of the stakeholders in a better way, right? If you think about it.
I think so.
And that is an indication that all of those strong economic factors in these businesses and the way that they're operated and the returns that they can generate for investors seems like it predicts that should continue to prove to be the case.
I would agree with that, Jason. I'm not saying they're not cyclical, but I think that there's less cyclicality than in the past. I think they will generate higher margins and higher returns on capital across a cycle than in the past. And I think over a long period of time, they will, as a group, and especially the best players that we discussed here today, will continue to outperform the market.
Well, you heard it right here, ladies and gentlemen. I think it would be fair to say that a basket of this 5 great companies in these various parts probably work out pretty well as a good way to invest in semiconductors over the next 5 to 10 years.
I think so.
Listeners, that does it for this episode of Industry Focus. If you have any questions or you want to reach out and say, hey, shoot us an email at industryfocus@fool.com or tweet us at MFIndustryFocus. If you're looking for more of our stuff, subscribe on iTunes or wherever you get your podcasts. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against stocks mentioned. So don't buy or sell anything based solely on what you hear. Thanks to Tim Sparks for all his work behind the glass today, and thank you for listening. Until next time, Fool on.